Hello and welcome everyone to this latest weekly market recap for the week ending Wednesday, February 19th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com, and it is a pleasure to be with you all again this week. Last week, of course, we had inflation coming in higher than expected. We've had rotation that's turned a little bit more defensive. We got weekly negative divergences in play on the major indices. We got options expiring this week. We're in the one of the worst historical periods of the month of February. And we've now moved into the second half of quarter one, which tends to be much more cautious than the first half of quarter one. And yet today we set another all-time high. Market seems to not care. And to be honest, this is what we normally see a lot of times out of secular bull markets. They put their head down, just keep charging forward, come up with all these different reasons why the market should come down, and it just doesn't want to. Market keeps going up. I'm not going to give up, though. I still think that there could be some downside action to come. One thing I can say is that while we are moving up and setting new highs, it's not exactly like the market's been flying. We did have pretty good action last week, so let's take a look at those numbers. Nasdaq 100 gaining more than 2% last week, so we did get a little bit of a pop in the Nasdaq 100 as it moved up to a new all-time high close. S&P 500 up 1.5%, also moving up, setting a new all-time high close today on Wednesday. Transportation stocks up 1.4% this week, although Wednesday today we did see a reversal on the transports. We did come back down quite a bit after challenging recent resistance level. We'll look at that chart in just a couple minutes. Russell 2000 up 1.25%, mid caps up 1.16%, and the Dow up 0.5%. What's not to love, right? Market just keeps going up, in spite of all the different warning signs that we've been talking about. But the warning signs are still out there. I don't think we can ignore them, but at the same time, it's really difficult to ignore all-time highs as well. Looking at the sectors, and this again, looking over the course of the last week, energy leading the pack up 3.35% this week. Technology doing well, up to almost 2.75%. That's good. We want to see, the riskier areas of the market do well. That was not the case on Wednesday today, but over the course of the last week, we have seen technology bounce back pretty nicely, along with financials. But one thing that's still a little bit bothersome is even with this solid week, with the Nasdaq going up 2%, look at consumer staples and consumer discretionary stocks. Neck and neck, actually staples doing a little bit better than discretionary over the course of the last week. So it's still giving us that sense. I mean, this is a really key ratio that I like to follow. Consumer discretionary, the XLY, relative to the XLP. It's one of the best, what I like to call sustainability ratios out there, in that when it's going higher, when this ratio is going higher, so when discretionary stocks are outperforming staple stocks, that tends to lead to the S&P 500 gaining ground. When we see the other side of it, when we see staples outperforming discretionary, we tend to see the S&P 500 falter. And I got a chart on that I'm going to show you in just a couple minutes as well. It doesn't look good, but the S&P 500 continues to fight, and we continue to move higher despite the ratio. Anyway, down at the bottom, you can see all 11 groups were higher over the course of last week. Healthcare, though, was the weakest, rising just 0.4%. 10-year Treasury yield. So we got the 10-year Treasury yield bottoming all the way back in September, down at 3.6%. We ran all the way to 4.8%. Now we're somewhere in the middle. Kind of interesting last week. We saw the core CPI come in hotter than expected, had a big bump up in the yields, which is what I would expect, given a hotter than normal inflation report or hotter than expected inflation report. But the next 2 days after that, look at it, we came right back down to where we, below where we were heading into that inflation report. So I still think that the bond market, the stock market, the way it's trading still kind of tells me that both markets are not really worried about inflation. Seems like that's just a Fed thing. But until the Fed comes out and says, hey, we're going to switch back and now we're going to go after the economy, we're going to start, cutting rates again, until we get to that point, or until we get to the point where the market anticipates that, I think it's going to be this, difficult run or difficult attempt to move to the upside. I think it's going to be difficult for small caps and mid caps. They started doing very well when we started cutting rates and when there were prospects of more rate cuts ahead. As soon as the Fed kind of squashed all that, we have seen the IWM underperform. And again, we'll look at that chart as well as the S&P and the Nasdaq here in just a couple minutes. In fact, let's go ahead and pull up that S&P 500 chart. So the S&P 500, you can see we were up at 6,100 back at the beginning of December. So yes, we set an all-time high today, 6144. That is a total of 44 points higher than where we were back at the beginning of December. And remember, most of this period was during the most bullish time of the year historically, October 27th close to January 18th close. So from beginning of December all the way through the middle part of January, we essentially went nowhere. That ended the historically bullish period. And since that ended, you can see we've basically gone sideways, tacked on a little bit to the upside, but nothing, nothing significant. So yeah, it's frustrating on the one side saying, hey, market, looks like it's poised to come down, and it's not. But at the same time, it's not like it's flying to the upside either. So we're just seeing this back and forth yo-yo. Looks like maybe we're going to break out, then we pull back a little bit, and it's just a lot of frustration going on right now. Now, I'm going to show you some of these sustainability ratios that I like to follow. So when the S&P 500 is going up, I like to see these ratios go up with it because it really gives us a sense of a risk on market environment. And that's what drives bull markets. You want folks to have an appetite for risk. And so when you look at these, I see here the QQQ versus the S&P 500. The QQQ is the Nasdaq 100, which is more growth-oriented stocks. Again, the S&P 500 is growth-oriented as well, but the QQQ is more growth-oriented. So when the QQQ is outperforming the spider, that usually is a good signal for the market. That topped back in July, and we had a nice run in December, but we topped there, and we've had a nice run the last few weeks, but we seem to be rolling over here. And each one of these, we're going down to lower highs while the market is trying to put in higher highs. So we're not getting what we want from that sustainability ratio. How about discretionary versus staples? This is my favorite one. And for a while, you go all the way back to the August low, discretionary was doing great, following right along with the S&P 500 to the upside. Perfect. Well, now we got the S&P 500 trying to make new highs. And look at this ratio. It's back at a 2.5-month low. This was very similar. It looked very similar to this at the end of 2021, this ratio. Now, I'm not calling for a bear market. I don't believe we have a bear market coming. But there's a reason why money is rotating out of discretionary. It's more, that's a more aggressive area. So if the market were to pull back, that's an area that probably would get hit harder. So it just looks like Wall Street, the big Wall Street firms are rotating into more defensive areas. The last one I'll show you here is the growth. This is large cap growth. It's the IWF, which is the iShares Russell 1000 growth versus the iShares Russell 1000 value. IWF colon IWD. Those are the two ETFs, growth versus value. And again, kind of like we saw with discretionary, except this started earlier, all the way back in December, you can see that for the last 6-7 weeks, we've mostly been going lower. Money is rotating away from growth. Again, that doesn't make sense when you got the S&P 500 still trying to make new highs. Nasdaq 100. So Nasdaq 100 also moving up in the new high territory. Not exactly flying, but hey, a new high is a new high. And then there's the small caps. See a little difference here? So since December, when the Fed started saying, whoa, 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 wait a minute, we maybe jumped the gun a little bit going after the economy, lowering rates, because now, that's back when they started talking about cutting the number of rate cuts in 2025 from 4 down to 2. That's what kind of triggered this. And we started to see small caps, mid caps underperform again. And we have not gotten a rally back in these groups, small caps and mid caps, like we have in the S&P and like we have in the Nasdaq. And I don't think I'm beginning to think we're not going to until the market becomes more convinced that we are going to cut rates again. So we'll see, how that all plays out. But at least for right now, these are just some of the warning signs that I've talked about in the past, and they're not going away. They're still there. So we can act like, okay, we're at an all-time high. We can ignore them. Remember, back at the beginning of 2022, we did move to a new high right before the bear market kicked in. And I think we could do something similar, maybe right before a pullback or maybe right before a correction, something like that. So I'm not convinced just because we're at all-time highs that we need to, dismiss a lot of these other warning signs. I think they're still out there. They could still play a role in what we see over the next 4 to 6 weeks. Transports, here was your rally in February. This was the recent resistance area I was just talking about a little bit ago. We got up close to it, and then look at us roll over today. Transports losing 1.5% today. Not a great day at all for the transports. Okay, so some of you out there I know are still free subscribers or just free users of the StockCharts website. I can only tell you that I've worked with StockCharts and I've been part of the paid package for over 2 decades now. And I I mean, and to me, it has everything I need. And I've grown so accustomed to being able to set things up the way I want with my chart lists, the scans that I use, and so forth, that I couldn't even imagine, going back and using something else at this point. But I want to show you one of the features that was a big seller for me. If you go into the charts and tools here, you can go over and you can pull up predefined scans. These are scans that StockCharts already has done for you. And you can click, new 52-week highs. If you want to see what they are, you could click on this 449. It's going to bring up all of them, going across here. Or maybe you're just interested in the Nasdaq. And so you come over here on the Nasdaq and you click on those 109, and you can kind of bring up all the Nasdaq stocks that meet that criteria that set new 52-week highs today. For me, I like to, and I think on this one, let's go back for a second, and I'm going to pull up a different. I think I'm going to pull up the bearish engulfing of the Nasdaq, and so here, what you can see is the 19 stocks that have bearish engulfing candles. Looks like maybe they're going to roll over potentially. And if you click on this button right here, edit scan criteria, you can actually go down here and just list all of these criteria. So these are the various criteria that are used in this predefined scan. Now, learning how to actually do the scan yourself, you can start with this, and I'm just going to show you what I would do. I'm not interested in over-the-counter stocks, so I'm going to get rid of that exchange. That's just not of interest to me. As far as the daily average volume being 40,000, that's pretty light for me. I'd rather my stocks be a little bit more liquid. So I'm going to put it in 200,000. And then I've got this daily bearish engulfing candle. And what we can do then is we can go down and we can adjust these. I mean, I could get rid of everything and we could just start to build our own scan. But if you're a member at StockCharts, you can go in and start creating your own personal scan. So I'm going to bring up the consumer discretionary and just add that in here. So now all of a sudden it's the same predefined scan looking for bearish engulfing candles, but maybe I want to go in and look at consumer discretionary and see what stocks are possibly reversing here. So I can run this scan and only one came up, so maybe, I could maybe run it against some other sectors if I wanted more stocks. But it's kind of interesting. Of all the consumer names out there, there was one that came back with a reversing candle. So let's pull it up, see what it looks like. Here you go. Got a big move to the upside. You got a bearish engulfing candle off of an uptrend. This could easily begin a move back down, maybe to test that rising 20-day moving average, which is where PDD has found support over the last month or so. So, stepping up from a free subscription or a free, using the free charts to the paid charts, once you get used to it, it is going to be a game changer for you. And like I said, I started this more than 20 years ago. at Stock Charts, and I'm still right here, not only using the platform, but telling everyone else about it because I believe that strongly in it. You don't see me pulling up charts from anywhere else. Keep that in mind. Give Stock Charts a shot. If you're struggling in your own trading and investing, I think there's a lot you're going to find on this website that can help you. And speaking of things that can help you, you also can go over to earningsbeats.com. We'll help you. If you go over to our main page on our website, you'll see an opportunity to sign up for a 30-day no-cost trial. I do also want to mention that we had a portfolio event the other day where we drafted what I like to call drafted our 10 equal weighted stocks for each of our portfolios. And by the way, if you scroll down, here's our history of these portfolios. While we're waiting for that to come, well, here we go. So as of the end of last week, our model portfolio is up 307% since the middle of November 2018. And the S&P 500 is up 127%. So we try to teach our members how you can construct portfolios to beat the S&P 500. Otherwise, if you can't beat the S&P 500, just put your money in the spider, SPY, and be done with it. Go golfing, go play tennis, go hiking. I don't know, whatever it is you like to do. I mean, if you're not trying to beat the S&P 500, I'm not sure what you're trying to do in the market, because to me, that's the benchmark. And it's easy. Just put your money in the SPY. To go through and to do all the other things, to me, there's got to be an end goal. And my end goal is beat the S&P 500. And you can see that our portfolios have done exactly that. Okay, let me move on because I want to finish this. It's options expiration week, and we also had an event last night for our members where we always look 3 days before monthly options expire. It's our max pain event. And what we talk about are stocks that could be dealt max pain by the market makers. And when the stock market's going up like it's been going up, what you have is a lot of companies, in particular, some of these big growth companies that have been going straight up, that are heavily traded in options. And what you find is that there are a lot of in-the-money calls that are out there on these stocks and hardly any in-the-money puts because they're trading at recent highs. Palantir was a perfect example. Last night, we held this Max Pain event, and we talked about the fact that there was a 1.3 to 1.4 billion dollars in net in the money call premium on Palantir. And essentially what I told members is, don't be surprised if out of nowhere Palantir gets hit to the downside. And that I feel like there's way too much risk to buy that stock as of yesterday's close, which was at 124 and change. Now, out of the blue today, I didn't know anything would happen, but look at Palantir on a 10-minute, 5-day chart, and look at what happened to this stock today, late in the day. Now, there was reason for it. The CEO came out and said that his plan to sell stock was changed, and he's now free to sell 10 million shares over the next 6 months. So the market didn't like that. Palantir shareholders didn't like that. So a lot of selling because of that. Also, Palantir does a lot of work with defense agencies. And there was word out in the Washington Post today that we could be looking at a possible 8% cut in the defense budget each of the next 5 years. Now, I don't think that's been confirmed. I think that was just a report. But the combination, I can't tell you which one did this and which one contributed more. But what I can tell you is that there was a lot of in-the-money call premium that was simply erased like that today. Pretty amazing stuff. So other stocks that are going through similar stuff, look at Meta. Meta was over 730, 735 2 days ago. Today, it gets as low as 695, wiping out tons of in-the-money call premium. How about Reddit? Since February 10th, stock's gone down for about the last 6-7 days, all the way to its 50-day moving average. A lot of in-the-money call premium, poof, gone. How about Robinhood? Hood up here got up to, I don't know, $66, $67. Today it was down, closed at 59, already starting to pull back. And I'll give you two more where we haven't seen those pullbacks yet. One is SMCI, super micro. There is a ton of in the money call premium because of what's happened over the past couple of weeks here. This stock's gone from $25 to over $65 today. This is in about 2 to 3 weeks. That's a lot. There's a lot of in the money call premium right now. And if you're holding calls in this stock, you might want to look around your shoulder because there may be some market makers trying to steal some of your in the money call premium coming up over the next couple of days. A little bit of a high wave candle here, a lot of indecision in today's candle. So might lead to some selling here short term. And then another one I'd be very careful with is Spotify. After just a massive move here recently and then earnings, gapping up with earnings, still trading up near the high. Don't be surprised if maybe we see a little selling here as well. Anyway, always interesting in the stock market. I really appreciate you tuning in. Please, if you like these stock charts videos, hit that subscribe button. Also hit the like button and help out stock charts as we go forward. Anyhow, I will see you next week. Have a great week ahead. Happy trading, everybody.